Okay, welcome back to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Okay, so it's November 20th. It's officially Friday. It's 12:30 Eastern Standard Time. Asian session is well underway. And let's take a quick look at the dashboard. So looking at the dashboard, the dollar, the 10-year, U.S. 10-year Treasury, gold, S&P, and crude oil. Let's see. So the dashboard is still hinting towards a risk-off sentiment, even though towards the end of the American session on Thursday, we had a pretty sharp reversal. We saw that across the dollar. Dollar went short. We saw that in gold. Gold, of course, responded by going long. S&P was up a little bit. I think even crude oil might have closed, positive a little bit. But the standout, the holdout in the whole thing was the 10-year Treasury. It did not move. It actually price moved higher and yields moved lower. And typically, you would see in response to a risk-on move like we saw in the rest of the market, the 10-year Treasury, the price should have fallen on the bonds, pushing yields higher. So that was the one holdout, which kind of suggests to me that the change in sentiment that we saw may have been more attributable to other markets, in particular the S&P 500 and even gold to a certain extent. But the yield market didn't reflect that change in sentiment, which kind of lets me think that that the underlying fundamentals that are driving the markets are still in play to a certain extent. Okay, so that's the dashboard. Looking at the trade book, this morning at the start of the American session, I was able to sell off. I had a couple option spreads on the SPY ETF and the GLD ETF, tracking S&P and gold. And at market open, I was able to close those out profitably. Timing was really good on that. Not necessarily due to anything specific that I did or anything specific that I observed. Just in this case, just good timing on my part. Because right after market open, the sentiment started kind of shifting towards risk on, and the gold and the S&P actually started showing signs of price appreciation. So the fact that those options are going to expire today, Friday, which probably, looking at where the market is right now, the strikes probably would not have been in the money at expiration. So yeah, good timing on my part. That worked out. That last minute move in the dollar did affect the corn position that I have open. The short leg of the trade, which was the back end of the calendar spread. I did see a price a chart pattern that that indicated a reversal, and I actually went ahead and added to the position. So now I'm basically in a holding pattern with that futures contract. So, but if the sentiment that is being reflected in the treasury market holds, which would be risk off, and the dollar gets back in line with the 10-year treasury market, which would also correspond with falling gold prices, weaker stock market, and falling oil prices. But if that sentiment holds going into next week at least, then we should see commodity prices fall a little bit and that trade get back on track. And also with the Euro US dollar futures, similar price pattern with the Euro dollar futures calendar spread that I had. Took off the front contract. That one was closed out basically flat. The back contract, which was a long dollar trade, went against me with that market correction adjustment at the end of the Thursday trading session. But again, if the fundamentals hold, then going into next week's trading session, I expect to see dollar appreciation, which would put downward pressure on commodity prices and should benefit the corn position as well as that Euro US dollar futures position. So a bit of a medium term trade, extending a little bit past the 1 week time horizon that I typically try to stick to. But with the derivatives, or the other derivatives, the options, those ones come hell or high water, they expire on Friday, so those trades get closed out. The one option trade that I do have left going into the Friday session is the 10-year Treasury. So I had a straddle. The price on the 10-year Treasury has been appreciating over the past few sessions, which has been in line with the risk-off sentiment, which also means that the call leg of the straddle is profitable. And what I did today was I went from a pure straddle, which is just one call, one put, to I added an additional call option. So I've got 2 calls to 1 put. So basically, the exposure for the Treasury going into Friday session is net long. But if the price action holds, I'm looking at the price trending, and I'm seeing some resistance levels that look like they're turning into support levels, and I also see a bull flag pattern that I've highlighted on the on a 1-day 30-minute chart. So going into the Friday session, I expect to see more price appreciation on the 10-year Treasury, and I also expect to see the dollar start appreciating, and a little bit of weakness in gold stocks and commodities across the board. As it currently is looking, the dollar is showing weakness in the Asian session, and so it's pushing gold higher, and S&P is also responding to that, and crude oil is down a little bit, and then the 10-year treasury is flat. So looking for a breakout of that bull flag pattern, probably coming into the open of the European session. So London Open around 4 a.m. New York time, Eastern Standard Time. And then from there, hoping to bring it on home sometime around the Open of New York. But and then also the Canadian spot currencies. So spot currency market, the Canadian, without the time restraints as the options, the spot currency, I'm able to take a bit of a medium term outlook on that one, similar to the futures positions. So again, just like the corn position and the euro US dollar position, the spot US dollar Canadian dollar trade is a long dollar trade. So of course, on one leg of the trade, long dollar, the other leg of the trade, short Canadian dollar, which is a proxy for the price of oil, which trades inverse to the dollar. So going into next week's trading session, expecting more dollar appreciation simply because of the fundamentals of the financial markets right now. But definitely looking at the 10-year treasury market as the market that is most reflective of the fundamentals that are driving financial markets right now. But the correlation between the 10-year treasury and the dollar is important, and it is important to monitor, because from time to time, intra-week, you do see the correlation switch back and forth from positive to negative. And when the correlation between the dollar and the 10-year treasury is negative, the 10-year treasury basically trades like a risk asset. So it trades just like stocks, just like other types of commodities. But in those types of situations or scenarios, typically the correlation on gold goes positive to the dollar, and it basically takes on the other safe haven category. So instead of safety in government debt, you just have safety in dollars and gold, which is basically more protection from the risk generated in the United States or generated by the U.S. government. Investors can just sit in dollars and gold, and when the risk when investors are attempting to hedge risk outside of the United States, then the safe haven assets would be the dollar for liquidity and the 10-year treasury for safety. So that's the relationship that I've been observing unfolding in these markets, and it does oscillate back and forth intra-week, so it's not something that tends to hold over long periods of time. So, and on that note, I'll go ahead and wrap it up. So if anyone has any questions, comments, concerns, you can always get in contact with me by email. You can email me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. And as always, I will try to answer the questions if I can during the next episode, or at best respond to your email with resources that can help you understand the problem that you're trying to understand or answer the question that you're trying to answer. Okay, and on that note, good night, happy trading, and when in doubt, take profits.